Hi, everyone, and thanks so much for joining us for today's webinar. My name is Marianne Hensley, and I'm the Vice President of Marketing here at FreightWaves. And we're excited to be here and happy to present this monthly market update webinar in partnership with Convoy, which is dedicated to using technology to bring reliability, transparency, insights, and efficiency to the trucking and supply chain industry. Today's market update is going to touch on many of the different factors affecting freight today. And we'll be hearing from FreightWaves CEO Craig Fuller, as well as our Chief Economist, Ibrahim Bayan. Before we get started, just a couple of quick housekeeping items. First, if you have any issues during the webinar, please feel free to reach out to our team via the chat function in your control panel. And if you have questions that you would like to ask our presenters, please enter those through the Q&A box in your control panel, and we'll answer as many of those as we have time for following the presentation. We'll also be sending a link to the recorded version of this webinar. So if you need to jump off early, or if you like to share it with your peers, you'll be receiving that here in the next 24 hours. At this point, we have tons to cover, so I'd like to go ahead and turn it over to Craig and Ibrahim to share their insights on the latest factors affecting freight today.
Ibrahim, it is so good to be back after the holidays and end of January. It's been a crazy month, so we have a lot to talk about.
Absolutely. It's been a while. Anxious to get at it.
Yeah, so I think there's about 800 folks that have actually signed up for this particular webinar. So it's certainly a lot of people are concerned about what's happening in the broader economy and excited to get into it. So this is Craig. Ibrahim is with me.
Afternoon, everybody.
So a little bit about my background for those that don't know. I grew up in the trucking industry, and I have been around it for a couple of decades. Literally grew up in the industry, and you were a trained economist.
That's right. I was a transportation economist at UPS for about a decade, and I did a lot of forecasting and economic analysis while I was there.
So we have a lot of really good stuff, and I think what we're going to do today is dive into the economic and freight performance. I'm going to give the perspective of the freight markets, and Ibrahim's going to dive deeper into the economic markets or economic elements. Talk about the government shutdown, the polar vortex, and a lot of different things. So our bios are on the deck if you get those after those, or you can read that on LinkedIn. One thing I also wanted to talk about, we have a couple of housekeeping items we want to get into real quick, is we are announcing the Shipper of Choice Award. Really excited and passionate about this particular award. There's been a lot of discussion about what a Shipper of Choice is. A shipper of choice is basically a shipper that operates with best-in-class service in terms of how they treat their drivers and carriers. And we've created an award to recognize the companies that are operating with high quality in terms of how they treat their carriers and drivers. And so this is a nomination that we encourage everyone to take a moment and recognize the shippers. If you are a shipper and you think you qualify, or you're a carrier or even a driver that is experiencing quality service in interactions with shippers, please nominate those guys, and we look forward to it. We'll talk a little bit more about that. There's more on the website. Also, real quick, we are launching Freight Futures. That will take place on March 29th. They will be the first listed futures contracts, and starting next week in New York City, we are doing a road show where we are going to 9 cities around the country, and we'll be talking about freight futures and trucking freight futures. So we're really excited about that. But let's get into it. I think we're ready to dive into it. Oh, I have one more announcement. Sorry. We are also announcing a radio show that will take place starting on February 23rd on Sirius XM Radio. It's a 2-hour show, which we'll bring our journalists and folks to talk about. Ibrahim, you will certainly be invited on there.
Absolutely.
So, well, great. Let's get into it. I'm excited about this. So a little bit about FreightWaves. We're using the community connected in the freight markets. These are participants in the markets that we use, informed by what we call tribal knowledge, and use technology and data to understand, analyze, react, and forecast, and then ultimately help participants de-risk the market. And that's really what we're all about. We have 2 full-time economists. We have up to 25 market reporters. I think that's pretty interesting. It's huge.
Awesome.
I think there was like 1 when you got here. So, and we're up in terms of total impressions per month, about 800 million. So we got a lot of stuff that we're going to get into, but I think it's time to get into the that. So one thing I wanted to do this time, a little bit different than last time, was actually give us sort of the high points of what we're seeing in the market and then dive into the data. And so Ibrahim and I made a couple of sort of just observations about the market before we dive into it. And this is really my observations, and Ibrahim will give his, which is what's happening in the market. Fundamentally, the freight market is slowing and capacity is increasing. It has increased. And we think that volume is down based on what we're tracking, 3% since last March. Capacity is up 2%. And then utilization, which is a really interesting stat, is up 4%. And what that means is the amount of time that drivers are dedicated to moving freight from point A to point B. There is more time due to the efficiencies gained through better shipper operations, better carrier planning, and better driver freight selection that have been created because of the ELD mandate. And we've seen that in the data, and that is actually increasing capacity across the board.
And from an economic standpoint, I think there's a couple key things to keep an eye on. The first is that I think it's pretty clear now that the economy is slowing down from where it was in the middle part of last year. I mean, when you look at 2018, like the second and third quarters were some of the strongest quarters of growth since the recession ended. And as you got to the end of 2018, the beginning parts of 2019, it seems pretty clear that the economy is decelerating right now. I don't think it's gone as far as to contract necessarily, but I just think that the pace of growth has calmed down quite a bit since the middle parts of last year. And more importantly, when you think about like how all this plays out in the freight markets, the things in the economy that help drive freight movements, I think, are doing worse than, say, the overall economy is. So, you know, we track a number of different indicators to keep tabs on what freight demand is doing. And it seems like the signs emerging from those are performing worse than, say, what an overall GDP number might be doing. So things like manufacturing, oil production, just international trade, housing, they're weakening, and I think, you know, they're weaker than what like the headline GDP number might suggest. So just to dig into that a little bit, I have here just where our current economic situation is. You know, I mentioned just a second ago that when you look back at 2018, the second and third quarters, they were really impressive quarters of growth for the U.S. economy. You can see 4.2% and 3.5% growth quarter over quarter. We think that the fourth quarter came in around 2.6% growth quarter over quarter. That's still above average. I mean, it's slower, but it's not slow by any stretch of the imagination. The first quarter, I think, is going to come in below 2%, and then we'll talk about some of the reasons why. That is below average from a historical or trend kind of perspective. And I think the beginning part of this year is getting off on a pretty weak footing for a number of different reasons.
And that's interesting because I've known you for a while, and usually you're more bullish than I am at times. And so for you to say it's slowing is sort of interesting.
Well, yeah, I mean, I take the data as it comes, and you know, I was pretty bullish when I met you because it looked like things were pointing up in the economy, and it turned out to be so. That 2017, the second part of 2017, 2018, those are really good times, but the data changed a bit, and I think you're going to start to see more of these readings that are around average. You know, I haven't gone as far as some other people have gone by saying, you know, there's an imminent recession around the corner. I do think that there are risks that sort of thing on the horizon, but I just think that you're in store for much more normal paces of growth instead of this above average growth that we've enjoyed over the past several quarters. So some positives for the first quarter. So the third quarter in the U.S. economy had a pretty big drag from international trade. There's an awful lot of import activity, not nearly as much exporting going on, and so there was a big subtraction that came from international trade in the third quarter. I think that died down a bit in the fourth quarter. I think the drag is going to be even smaller in the first quarter, and there's still a decent contribution from government. It's not as large as it otherwise would have been because of the government shutdown, but there's government still contributing some to growth during the first quarter. But with that said, there's also a number of areas of weakness. Consumer spending has been one of the highlights in the U.S. economy over the past several quarters. Like the first quarter of 2018 wasn't great, but second, third, and fourth quarter, I think were really strong quarters of growth for consumer spending. I think that's going to die down a little bit during the first quarter when the numbers come in. I also think that business investment demand has died down significantly towards the end of last year and the beginning parts of this year, that there's just not as much appetite for investment among businesses. Housing activity has been weak, and I think it's just going to continue to be weak for a little while. There's still some structural problems within housing that are preventing a more robust kind of contribution from the housing sector. But I don't expect any big contributions from housing anytime soon. And then, of course, you have the government shutdown impacts, which took a quarter that I thought was already going to be pretty soft and made it even weaker. I don't think the overall impact from the government shutdown is huge yet, but it's definitely noticeable. And it's what pushes it below this 2% range during the first quarter. So to talk about the government shutdown, you know, the last month when we gathered here, I remember saying that like it's a partial shutdown. So it doesn't have the same impact as like what a full shutdown is going to do, but the ultimate damage that it's going to cause to the U.S. economy depends on how long it lasts. And so here we are like a month later, and it turns out that this government shutdown was the longest that we've ever had in U.S. history. It's been resolved temporarily, right? Congress and the president agreed on a temporary 3-week reopening of the government to try and find a more permanent agreement. But I do think that there's some damage that's already happened because of the shutdown. For one, you get like the government workers themselves, they get their back pay, but like all the contractors that work with the government, or if you're a driver that carries loads for the government, you don't necessarily get back pay when the government reopens. So you get some damage there. You get whatever lost productivity that happens from just not having these government workers doing their jobs. And so I think the damage is around 0.2% of GDP in the first quarter. So you can kind of think of the first quarter as that it would have been around 2% growth, but instead it'll be a little bit below. The more concerning thing about the government shutdown is that there's a chance that there's going to be another government shutdown in a couple of weeks, right? This temporary agreement lasts us until February 15th. But there wasn't any real compromise that was made in order to get to this temporary agreement, right? Like neither side really budged. They just decided that, you know, they couldn't afford to have the government shut down any longer. And so there's a chance that once we get to February 15th, they still haven't budged, and you find yourself right back into another government shutdown. The other thing that I would say is that, you know, this government standoff was really the first test of how this power dynamic was going to work out, with the Democrats controlling the House, the Republicans controlling the Senate, and Trump in the White House, right? And it ended up to just be like I can't imagine it playing out any worse than it actually did. And so, you know, we're going to be looking at this kind of environment for the next couple of years. For those of you guys that were paying attention during the Obama years, we had the same kind of problem where, you know, the president was one party and Congress was another, and you ended up with just like political gridlock during the entire period. And so I would expect that, you know, this probably isn't the last time that you get this sort of standoff between the Republicans and the Democrats in politics.
Now, it seemed to me that the air networks, when the TSA was at risk and the air traffic control was at risk, is what solved the. Do you have any perspective on that?
Well, I mean, I think
everything.
There's no coincidence that they decided to reopen the government right after LaGuardia shut down.
Yeah.
Like I think that's kind of what made it real for a lot of these politicians that were in D.C. That, like, you know, one of the busiest airports completely shut down, and it was starting to cause real disruptions. And so obviously you can't have that sort of thing going on for weeks and weeks on end without, you know, completely disrupting the overall economy. And I think they realized that, and we're like, okay, we have to do something here. And so I'm not exactly sure how it all gets resolved once this temporary agreement plays out. But I think it's pretty clear that they're going to have to find something. The bigger problem, at least from my perspective, with the government shutdown is that it's disrupted a lot of the data releases that are out there in the economy. So I put a quick screenshot of what the Census Bureau's website looked like during the government shutdown, and you can see that there's just like a big headline up there that says, "Due to lapse in federal funding, we're not updating anything." And so this means that like all the pieces of data that the Census Bureau and the Bureau of Economic Analysis collect, they hadn't been released at all during the government shutdown. And even now that the government shutdown's been resolved, they're still working with backlogs of trying to get data out. So there's still an awful lot of economic data that's not being reported. Now, ordinarily, so in normal times, you don't really worry as much about not having the data available. So say, for example, if this shutdown had happened in the middle of last year when we all knew the economy was growing and growing above average, I don't think it would have been as big of a deal to not have the data to confirm it. But the economy is kind of transitioning right now. Like, we're exiting this period of high growth into a more modest pace of growth. And there's a lot of policymakers that are trying to make sense of where the economy is. The Federal Reserve, you know, when they, in a statement that they put out yesterday, when they talked about why they put a hold on raising interest rates, part of what they said is that they're just waiting for the economic picture to get a little bit clearer. And buried underneath of that is that they don't have all the data either. And so it's made my job a lot more challenging than it normally is, because there's certain things that I look for that haven't been released. And I think it's going to be like that as they kind of work through the data backlogs going forward. So we're going to start with some of the data that we do have and talk about how we form our economic opinions here. I wanted to start with the manufacturing sector. Here I have total industrial production, which is the white line, and then I have manufacturing industrial production, which is the green line here. Manufacturing activity actually did better than I think most expected at the end of 2018. There was a big pop in December readings for manufacturing industrial production. But that doesn't necessarily mean that everything looks good from the manufacturing point of view. I think there are quite a bit of headwinds still facing the manufacturing sector. For one, you know, as I mentioned at the onset, I don't think there's as much appetite for business demand in the economy, and that drives a lot of manufacturing activity. When you talk to manufacturers or surveys of manufacturers, they almost universally report that they're still concerned about what the trade environment is going to look like. And so that's withholding some manufacturing activity in the economy. And so I still think as you go forward, I believe that the growth rate is going to start to die down from where it is right now. I mean, manufacturing is still growing over 3% year over year, but I think as you get to the first quarter of 2019, throughout the rest of the year, you see a softer pace of growth for the manufacturing sector. So to underscore this, I pulled some data from the Institute of Supply Management. Now, this data is essentially surveys of purchasing managers for manufacturers, and they ask essentially whether or not activity is expanding or contracting in their business. And the number that comes out is the percentage of respondents that say that activity is expanding. So if you get a number over 50, that means more than 50% say that activity is expanding. If you get a number under 50, that means more than half are saying that activity is contracting in the sector. And so historically, when you get readings above 55, that usually correlates to like above average growth in the manufacturing sector. And you can see throughout the majority of last year, you had these really strong readings well above 55. Manufacturing reached like a 14-year high in the third quarter of last year, but it's come down quite a bit. You can see the severe drop-off in the December data for manufacturing. Again, you're still in expansionary territory. This reading of 54.1, it's not that bad. I mean, it wasn't that long ago that I would have been excited about a reading of 54.1, but it's down significantly from where it was just a couple months ago, which means it's an indication that manufacturing is actually going to be slowing down. So when you drill into the manufacturing ISM data, there's a number of different aspects about business activity that they ask about, right? And so I pulled a couple here just to illustrate where I think manufacturing is going. The white line here is the backlog of orders, and the green line here is new orders for manufacturing activity. Now, new orders saw a severe drop from November to December. New orders typically lead shipments in the manufacturing sector by about a month or two. And so, you know, you're seeing these positive readings for manufacturing activity right now, but the new orders data suggests that the demand really isn't there going forward.
Green is new orders?
Yes, the green line here is new orders.
So that's suggesting that new orders are slowing down faster than the existing?
Yeah, well, they're still expanding, but they're growing at a significantly slower pace. And so when you're thinking about like where manufacturing is going to be in a month or two, the new orders data suggests that it's just, you know, it's not going to see the same pace of growth that it's seen in the past. The white line is the backlog of orders, right? And that's also been dropping, which means that not only is the new orders been dying down, or the growth in the new orders been dying down, but firms are also getting a chance to work through all the backlogs of orders that are out there. And in fact, I think a lot of the strength that you saw in December was really just like firms getting caught up on a lot of the orders that were there and working their way through those. And as you get into January, February, March of this year, you're going to start to see manufacturing activity die down some. On the retail side, retail and inventories is one of the areas where we haven't had an awful lot of concrete data. The Census Bureau collects a lot of this retail data. And so the last actual data point we have for the retail sector is still November, which means that we don't even really know how like the holiday season overall shaped up for the retail sector. So it's a little tricky to put projections on where retail is heading if you don't know how retail performed during the busiest retail months of the year. Now, with that said, you can still kind of understand the overall consumer environment and help explain like where retail is heading from that standpoint. I think most of the fundamentals for retail are still pretty strong. The job growth numbers and the wage growth numbers still provide an awful lot of support for retail spending. And as long as that remains strong, retail should have a solid foundation. A little concerned about the plunge in the stock market in December. I think that weighed down, that's probably going to weigh down consumer spending as you look in like the early months of the year, although stocks are up this month, so maybe, you know, if there's a drop, it'll be temporary. But when you look at things like consumer confidence, that's also come down over the past couple of months. Again, part of that is probably due to the stock market crash in December, but the government shutdown is also playing a role in like how confident consumers are feeling. And so even if the fundamentals are there for people to spend, they may not go out and spend just because they don't feel that great about the economy. And when you look for overall 2019, you know, I've said this all, you know, for months now. Like I just don't think the consumer spending growth is going to be as strong as it was last year. In part because you don't have the same kind of boost that you got in 2018 from tax cuts. Although consumers should be helped a little bit by having lower gasoline prices in the early parts of the year. So this speaks a little bit to what I was talking about with consumer conditions. I wanted to show labor market trends in the economy. Now, normally, you know, I typically look at like the month-to-month change, which has been strong, but I wanted to step back a little bit just to show sort of the trends in hiring over the last several years. And you can see that it's basically been like a straight line since the recession ended, pointing with about the same kind of slope. I mean, 2014, 2015 was a little bit stronger than normal hiring, but for the most part, the economy has just been hiring at a very steady, very high pace over the past several years. Now, that's pretty impressive considering that unemployment's already low in the economy. Like normally when you get to unemployment that's around 4% or below, the pace of hiring slows down because they run out of available workers to find and hire. But that really didn't happen last year. And the pace of hiring just kept on chugging all the way through to the end of the year. I mean, December's job numbers were over 300,000 jobs added for the month. And so just a very impressive year of job growth. The one thing I would say about that is that job growth as an economic indicator is usually like a lagging indicator, which means that things in the economy tend to go south before hiring trends go south. And so there's a tendency for people to look at the job numbers and say like, oh, everything's okay. But if you follow that rationale, you're always going to be behind because by the time the job numbers slow down, the economy's already slowed down around it. On the trade side, this is another area where the data has been sparse. There was actually supposed to be a trade release like the day after the government shutdown started. And so we're a couple months behind on trade data. Where we left the economy, both import and export growth was fairly strong. But I think there are quite a bit of concerns about the trade sector. For one, because of tariffs. Like there's a lot of the reason why they were stronger than normal export and import growth during the third quarter, beginning parts of the fourth quarter is because people were trying to get things in and out of the country before tariffs. But I think the bigger concern is really that the global environment doesn't look that good anymore. Like when you step outside of the U.S., and if you think the U.S. economy is slowing down, I mean, you should see what's happening to the economic indicators out in Europe or in China. And that's going to it's going to have a bigger impact to our own trade patterns, more so than like any kind of tariff policy or trade policy. And so there's a real concern that like as you go forward, this slowdown in global growth is going to start to take a hold in our export growth and and cause that to slow down, even if they're able to resolve sort of tariff concerns. So to take a little bit of another look at this, And I pulled up some more data from the Institute of Supply Management. One of the components they ask manufacturers about is like what your new export orders are looking like in the economy. And so the white line here is the Institute of Supply Management's new orders. And then the orange line here is actual trade in export of goods in the economy. And you can see they track pretty well with the ISM data usually leading goods exports by about a month or two. So you usually see it in the ISM new export order data a couple months before it actually plays out in the export numbers. The good news about the ISM data is it's not government data, so it's not, you don't have to worry about it getting being withheld because of the shutdown, and so it's a lot more current than the goods export data. And you can see the pretty severe deceleration there in exports over the past couple of months. And so when thinking about like how export performance is going to be as you look in the first quarter of 2019, I think it's going to be softer than where it was, say, in the third quarter of last year and the fourth quarter of last year. Shifting gears a little bit and taking a look at sort of capacity within trucking, I wanted to pull up just sort of the amount of trucking hires in the economy. So this is data from the Bureau of Labor Statistics on employment within the trucking industry. 2018 was a very impressive growth year for trucking hires. Over 36,000 jobs were added within the trucking industry, just the payrolls. That's the best year of growth in employment hires for trucking since 2014. And you can see just like a clear uptick in the pace at which the industry was adding workers once demand kicked into high gear last year. Now, again, like the overall economy, this is also like a lagging indicator. So if you look at just like the pace that truckers are adding jobs and say, okay, you know, everything is good in trucking, just keep in mind that it's likely that like things are going to turn south for demand for freight before hiring responds, because it typically lags behind the overall activity. The last little piece is on rates. So, you know, we typically track, from a government perspective anyway, we track the producer price index data for the trucking industry. Now, producer price index data is essentially like the price that businesses receive for the services they provide. And so what I have here is essentially a measure of the rates that the trucking industry is receiving for the services that they provide. Now, you know, in the previous slide, I talked a little bit about how hiring has been pretty strong throughout 2018, and this hiring turns into increased capacity for the trucking industry. I also think that the economy is kind of slowing down right now, and so you have increased capacity for trucking. You also have softening demand growth for trucking. That should eventually lead to weaker rate pressures and sort of a softening in the pace of growth in trucking rates. I just don't think it's happened quite yet. Like when you look at the government data, it still looks like very strong pace of growth in trucking rates. I do think as you go forward, it should start to slow down some because of the idea of increased capacity and softening demand.
So that, Ibrahim, really appreciate that update. One thing to point out, you're using a lot of government and sort of macroeconomic data.
Sure.
And as we sort of dive into the specific trucking and freight market update, it's interesting because the government data, some of it has not been recently available. Some of it just lags by nature of it. Tends to look much more, as I said, bullish or more strong or indicate stronger conditions than what the underlying freight market data looks like.
Sure. And I think that goes back to what I was saying in the beginning. Like if you were just to look at some of the headline numbers from the economy, things look like they're decelerating, but not necessarily. I mean, decelerating at a fairly modest pace, right? So no reason to really panic as far as that's concerned. But I think once you drill down and start to look at some of the things that are more directly tied to freight demand, freight movements, I think the outlook is a bit weaker than, say, what the headline numbers for the economy might say. Yeah.
So one of the things that we have done, so this data is coming from really electronic transactions in the market, is we decided over the past 2 years that there has to be better ways to get near-time information. And so we created a number of indices. We're actually putting about 100,000 a day into Sonar from a lot of different sources of data and a lot of algo or machine learning algos, One of those is the outbound tender volume index. The OTVI basically measures the total amount of transactions in the market, indexed at 10,000, effective March 1st. And so anything above 10,000 is growth above the March 1st number. Anything below 10,000 is a deceleration of the March 10 number of 2018. And what we're seeing is that the freight market as of today is off a little bit more than 3% in terms of volume from March 1st. Now, let me caution to say that March 1st was a bang up month last year. And so it was, or that just a period of time, that was a time when freight volumes were really, really high. So it is a number that is perhaps inflated versus what we would see if we didn't have that huge acceleration. But having said that, we do know that freight volumes are slowing down versus what they were last year. And in fact, the reading we have in January is as low as any point last year. And so we're not seeing sort of any increases in volume, really no underlying growth in freight activity into this year. And that certainly has us a bit concerned. The other thing is, it actually, throughout the month of January, we've seen the volume slow down from where we started, which is also slightly concerning. If we look at specific quarters, one thing that Ibrahim mentioned was that import data has been delayed from the government. And so we can actually look at fundamental freight data to draw different conclusions and actually get to the import data. One thing that we've noticed is that Southern California, particularly LA, has been on fire. It has been insane in terms of LA as a origin point has had more freight originated in the month of January than any point last year. The other thing to keep in mind is that LA heated up about a week, and what we looked at is we isolated LA and then we looked at Ontario, California, because what we wanted to understand was this just imports coming in, and then were they going out of the market, or were they staying in warehouses and being staged? And what we saw was imports were coming into LA, and it took about a week for them to go from LAX, the market of LAX, into Ontario, California. And about a week later, Ontario heated up. Ontario has not yet heated up to the level in terms of volume that we saw out of LA, which is suggesting that a lot of the freight is still being staged. And it may just be supply chain companies securing the supply chain in case there is any more disruptions in trade policy.
Well, I think there was a lot of talk of that kind of thing happening when you look at like the third and the fourth quarter of last year, because keep in mind that originally there was a pretty hard deadline of January 1st of this year where tariffs were scheduled to kick up significantly. And so I think the prevailing thought was that many of the businesses located in the U.S. were trying to get things inbound from China before that hard deadline. Now since then it's been postponed, but I think the activity there speaks to some of that.
And we're seeing it, and it's not just Southern California. We've seen it at the ports on the East Coast, like Savannah. We also see Joliet, Illinois, up until the weather has been really, really strong, which is suggesting that intermodal carriers, companies that are hauling boxes, are doing exceptionally well over rail because it's not time-sensitive freight. Truckers, unfortunately, are not seeing sort of the same conditions. And so companies that have dedicated or consistent movement, and I mean dedicated as in contract carriage, or have consistent sort of DC to store movements, are still in a fairly good shape. And that is why the larger enterprise asset carriers are more bullish than the rest of the market suggests that they are, is because they're in many ways more insulated, and particularly with more exposure to retail than what we see with some of the other parts of the market. If we look at one of the other fundamental data points that we look at is what we call the outbound tender reject index. And basically this is a reflection. I'm going to use the word contract pricing because everybody in this space uses it. I personally don't like the word contract in talking about trucking rates because there's very little take or pay in trucking. However, it's a term that does get used quite a bit, so I will use it in this context. But what it means basically is a firm price and an agreement to have a commitment of both volumes and trucks showing up. And what we're seeing, we measure that through our OTRI index, the OTRI. This basically measures the percent of loads that are rejected from carriers. In other words, out of 100 loads, the lower the number is, this is 7.65, that means out of 100 loads, 7.65 of those loads are rejected. It means that carriers are turning them down. What that tells you is really, do carriers have other options? The lower that number is, the more bearish or the worse the conditions are for carriers. And it means likely that pricing, if you still see that number going down, it means that pricing is likely to continue to be under pressure. And so we're seeing that the OTRI index is suggesting that volumes are still down. Even in areas like Southern California, which are seeing record volumes, we're still seeing that OTRI number actually show worsening conditions, which is suggesting that that even though you have pockets of high demand, it's not changing the capacity map very much. If we look at spot market rates and sort of look at it on a national basis, it even looks worse. And the reason it looks worse is spot is far more exposed to directional rates in the market. This is a basket of rates that we get from DAT related to the futures market, specific lanes. And basically what we're seeing is the spot market rates are in what I would call free fall conditions. They have dropped by 22% since the new year. And it looks to be really, really bearish. Now, if you follow that over the course of years, January is always soft. Spot rates are always soft in the first quarter. January 2018 looks to be an exception, and really 2018 overall in freight looks to be an exception. But certainly there's a lot of downward pressure in spot. The thing to keep in mind is that we would expect carrier ability for carriers to get higher rate increases seems unlikely at this point in time, except in certain cases and certain lanes or commodities. It also suggests that 3PL margins are expanding, and I would imagine that shippers are probably finding really a low-cost movement of trucking services by being able to play with the routing guide more efficiently. And so I would expect more freight to hit some of that spot market carriers as shippers sort of start to wake up to the fact that this may be a little more long dated than what we would certainly like to see. The other thing that to watch, one of the other things that we look at is oil. And keep in mind, this is an important fact, is that shipping fuel surcharges are set at DOE rates. These are assessments done by the Department of Energy on retail truck stop prices. But most enterprise carriers actually buy fuel on rack prices or wholesale prices. And so we actually monitor both the DOE, well, we monitor the DOE index, which is the national assessment that comes out weekly. We monitor the retail truck stop average prices, which come out on our systems daily. And then we monitor the rack prices, which are also daily, which are really what the big truck stops and are paying for fuel, but also what the carriers that have rack-linked prices are paying. And what we've seen is, as the wholesale WTI price has dropped tremendously, as we discussed earlier, as that has dropped, we've seen broader expansion of that spread between wholesale and retail. And what that means is that the larger asset carriers that have rack-linked pricing will actually see expansion in margins. And so looking at the fourth quarter, we actually saw a lot of expansion in the spread, which means, keep in mind, their billing fuel surcharges were set at one price, and they're buying at a completely different price. The thing not to get caught up in is taxes and transportation is not in that spread number. It's actually the movement of that spread number and the volatility that's more interesting. But you saw that the spread in really throughout 2018 was around, it really hovered between 70 and 80 cents a gallon, up to as much as 90 cents. And then it just took off in the fourth quarter, where it got as high as $1.38. And so that's a pretty significant expansion and represents about 6 to 7 cents a mile for carriers. We're seeing that come down. I think it will be a bullish sign for carrier earnings, at least in the first quarter, if it stays pretty strong. But it also is something to watch as we move into the rest of the year. At some point, the retail prices will come down. The truck stops have to pass those savings on, but they seem somewhat more stubborn than they have in the past. And this is also telling right here is net fuel expense as a percent of company fleet, just 5%, which is as low as fuel prices as a cost. Unfortunately, we don't have the fourth quarter data just yet, but I would expect that net fuel expense as a percent of revenue would actually be less as carriers benefited from those widening margins in the fuel spread. WTI and diesel, we talked a little bit about it. They're very tightly correlated in terms of the retail or the rack price, the wholesale price, and WTI. They move in tandem, and so you can actually understand what WTI is doing or what rack prices are doing by looking at the WTI number, but it's important to keep in mind. When I sat down with a major oil producer 2 weeks ago, and he suggested to me that even though WTI is in the low 50s, that actually because of the lack of capacity and infrastructure, that it didn't make sense in terms of recovery cost to actually move the oil. It's trading in the low 30s. And so even though we see crude oil in the 50s, it doesn't mean that the producers are actually making that. They're having to pay as much as $20 to move the oil from the fields out to the refineries, which is really impacting them. So we'll see. It's going to be interesting if there are going to be some structural issues that we've seen in oil a couple of years ago. Operating ratios are still at, I would say, very solid numbers, really buoyed by relatively good volumes, even in the fourth quarter. Pricing that has been strong, particularly the dedicated and contract side of the business, committed side of the business, and those margins and spreads. And so I think the challenge is, as you sort of look into 2019, first quarter and second quarter, and perhaps the later part of the year, is those year-over-year references. It's going to be very hard for those carriers to sort of maintain the momentum. And that's perhaps why trucking stocks have sold off so aggressively, at least in the latter part of 18, is just those year-over-year comps are going to be quite difficult. As we look at another index that we recently acquired, which is air cargo rates, and this is one of the most interesting charts I've ever seen. And the reason it's very interesting is really two things, and I'll talk a little bit about air freight in a second. But this is an assessment of air freight prices against the DAT spot trucking prices from LA to Dallas. And I don't know, other than that WTI chart and rack price that I showed you, that is actually one is the wholesale price of diesel versus the wholesale price of crude, which is actually directly one's an input versus an output. This is an insane chart in terms of correlation. If you look at how tight air cargo spot rates out of Hong Kong to North America are, overlaid with DAT trucking spot rates from LA to Dallas, that is a really tight movement. And it shows just how interconnected that particular market, LA, is in terms of trade. Air cargo is really a reflection of tighter inventories, which is another thing that perhaps woke the administration up to the fact that they didn't want the air network shut down, because that would really have a huge impact on supply chains. But it's also just a reflection of sort of trade demand and stuff. And so what we also see with air cargo is typically when the economy slows down, it's the last in, first out of a cycle. So any sort of, when inventories start to build, air cargo being, sometimes as much as 20 to 30 times the cost of moving the same weight over a truck, will get deprioritized. And so we're seeing air cargo rates come down as well, and so it's interesting to see what happens. One of the things that also gets discussed is the impact of Amazon and e-commerce on FedEx and UPS. And I thought this was a really interesting slide showing the question's always been, what impact is Amazon in terms of air cargo volume having on the big package carriers and parcel carriers? And if you looked at this chart, it would suggest nothing. I'm not naive enough to believe that there isn't an impact. What it does suggest is, overall, the entire pie is getting bigger, and e-commerce is becoming a much more important part of the supply chain. And even as Amazon becomes bigger and more important in terms of demand, it isn't necessarily taking growth away from the big parcel carriers. I mean, you came from there. You have anything to add to that?
Yeah, I mean, I think that's kind of long been the argument that the UPS and FedEx have been making. It's just that e-commerce grows faster than either one of them is really willing to invest in the capacity to handle. And so a lot of what Amazon is doing is to add overall capacity to the market instead of just trying to snatch volume from one or the other. I mean, the reality is, I mean, e-commerce grows 15% every year, right? And so somebody's got to carry all of that stuff.
And it's only, what, 12.5% of retail sales?
Exactly, and there's no signs of it slowing down. And so, you know, when you look at like how fast Amazon's been expanding in this kind of space, just keep in mind that they have to keep up with a lot of that stuff, a lot of that growth that's out there.
So I think that's really interesting. There's a lot of discussion around it. One of the other things that we have done in our partnership on this particular webinar with Convoy is actually take with their data scientists to understand what's happening. So they've been able to provide us this data to talk about what they're actually seeing in the market. And it's interesting to see a company as innovative as Convoy bringing technology and new solutions, but they're also certainly looking at what the market conditions are taking place. And if you look at their chart, you know, the West, the South Central, and much of the Midwest, at least relates to dry van, capacity is plentiful, which would suggest that prices are probably going to come down or continue to be under pressure. Reefer in the Midwest or temperature controlled is tight. And I think, you know, if you didn't know much about trucking, you would look at that and say, well, it must be refrigerated goods. It's actually temperature controlled, and they're actually trying to maintain a certain finite temperature. So if you're hauling beer or water, you don't want it to freeze. It will create a mess. Anyone who's ever left a soda or a beer in a freezer would know that. And so that refrigerated temp control stuff continues to be in tighter demand than what you see with the dry van market. We see sort of moderate conditions on Convoy's data in the Southeast and Northeast, really moderate. So it looks like a stabling condition with pressure on either side of it. The one thing that's also interesting, I think this is a really interesting slide, and it goes back to what I mentioned earlier, which is we using our own data, and this is confirmed by Convoy's data, is that we're seeing more efficiency in how shippers are managing driver in and driver out. We mentioned the shipper of choice being really a theory that shippers want drivers to want to do business with them, or carriers to want to do business with them, so they're being more efficient. But it also suggests that as demand has fallen, and perhaps, and we hope, I'm trying to be optimistic here, I hope it's that shippers are being more efficient, so have facility pickup wait times. Is that as demand drops off, the time that drivers are stuck at docks is also lessened. And so it's interesting to watch that, and we'll see if that changes. But it is suggesting and sort of reconfirms the fact that there is some slack in the system. I'm not going to spend a lot of time in weather because I am not a meteorologist, and you just turn on the Weather Channel to get it, or tune into FreightWaves. But anyway, record cold. It's freezing. It's cold out there. I don't want to be in Chicago. How about you?
Oh,
so
definitely not.
One thing to keep in mind is what happens in Chicago not only impacts the Midwest, but all of the highways that transverse it. So if you're going from the Northeast to Southern California or vice versa, you're going to be impacted. And the intermodal freight as well that's on those trains is also going to be impacted. So there will be a lot of secondary sort of issues related to that. This map is showing precipitation. We have a new system, a new product that we're rolling out inside of Sonar. And I showed this last night. That is a street in Chicago about 9 p.m. and it is completely empty. There is not a car on the road. This is one of the biggest cities in the country. I thought that was really cool. I took a screenshot out of it, but it is completely empty. Nobody wants to be out in the cold. So, Ibrahim, let's talk about the summary.
Yeah, I mean, I think when you're thinking about the freight markets overall, from a demand and supply side, on the demand side, I think it's pretty clear that the economy is slowing down. Again, I mentioned that the things that tie most directly to freight, they seem to be slowing down faster than the overall economy. And the real worry that you have is just like, if you know capacity is being added, and you know the carriers are becoming more efficient and shippers are becoming more efficient, so they're using their time better. At the same time, the demand is falling, you run the risk of falling into a situation where there's more capacity out there than you know what to do with. And so you could find yourself pretty quickly in the reverse of what we saw last year. I mean, last year was all about, there being loads all over the place and not enough drivers and not enough trucks to carry them throughout the country. And here we are, with demand slowing and capacity expanding, where the roles might be reversed significantly. Again, I don't think that's necessarily going to be the case, but I do think that there are plenty of risks out there that might drive us into that kind of situation.
And what you rate increases remain strong. That's based on enterprise carriers coming back to talk about higher rate increases.
Yeah, I mean, and it goes back to what I was saying earlier. Like when you look at the contract and spot rates in total, at least through the end of last year, that they seem to still be fairly strong. Like the rate increases hadn't quite slowed down yet. But I think the environment is certainly there that's going to put the downward pressure on it as you go forward. So it's been strong enough so far, but I think there's plenty of downward pressure on rates to watch out for.
Yeah, I would be on the more bearish side of what has been reported, but I do think the enterprise carriers are more insulated from the broader market, just because of the quality, the significant amount of capacity, technology, and the fact that they have core carrier relationships, and shippers are reluctant to get rid of it. So I think we have a couple next steps. Marianne, talk a little bit about the Sonar subscribers can get the Market Experts Daily Watch published at 10 a.m. daily. Mm-hmm. And then also all these screens are provided on the Sonar Market Dashboard. Reach out to Michael Vincent if you don't have a subscription to Sonar. We're adding new data every week, as well as some new features. That hybrid camera, I'm really, that is so cool. I like completely freaking empty streets in Chicago.
Well, I mean, I think back to the early days of Sonar and like what the original version of Sonar was. And the amount that we've added over the last few months has just been phenomenal.
It's funny because Convoy, appreciate the folks from Convoy. Reid Hoffman's an investor, and he's written a book called Blitzscaling, which is all about basically you should be embarrassed of your first product. Right. I look back and sort of feel that way. So anyways, I think we have time for some Q&A.
We do have a few minutes left. So for those of you listening in, if you've not already submitted your questions, please go ahead and do so. We'll get to as many of those as we have time for. So question number one, why do you believe there is more driver capacity than in 2017, and where does the data around that come from? Well,
I'll start and you can add it. Driver employment. So I think what happened is you had really strong conditions that drove prices up, and so you had credit was flowing pretty freely for drivers to get new trucks. Carriers were able to add new trucks and grow. And even driver employment, as much as carriers did talk about struggles to get drivers, it didn't work itself out, because I don't want to be dismissive to the fact that there are real structural issues in getting drivers. But carriers did put incentives in place to hire drivers. They did increase the salaries and pay for drivers. And a lot of that just came into it. And so almost in every single one of the large public carriers, as well as just channel checks, almost every carrier was growing some percent of their fleet. And you wouldn't be growing your fleet if you couldn't add drivers. Why would you buy new trucks if you couldn't do it? So,
no, I mean, I would agree. Like, I think, most of the talk around like the shortage of drivers, the inability to find capacity, revolves around just the trucking employment. And I would add to that, keep in mind that like these BLS numbers that get officially reported by the government, like it's just payroll employment, right? And so that means that you have to be actively on somebody's payroll, and it doesn't really include like all the independent drivers that might be out there also. And the other thing that you find like over the last year or so, there's been a lot of technology that's just aimed at making it easier for like an independent driver to get up and do business, right? I mean, it's the ability to find loads that are out there. I think it's easier now than what it would have been 5 years ago or 10 years ago. And so you can even consider that even the official numbers say that trucking hires are up, but there's probably also a lot of extra activity that's going on behind the scenes. It's just people that are able to enter into this market that otherwise couldn't.
Yeah, I think looking at the FMCSA growth numbers in small fleets, but to your point, companies like Convoy and other digital brokerages and plentiful available capacity and technology it's never been easier to be an independent driver. And if you can get credit and you can run your business responsibly, the tools that are available to you are tremendous. And so I think that's an area that's a factor that a lot of the carriers are not thinking about in terms of growth, is with these new digital upstarts that are that are providing an easy way and a friendly way for drivers to operate and make it profitable for them to operate, it's going to be more difficult to sort of maintain that capacity control.
Yeah. So. Cool. All right, and then we have a question relating kind of back to one of the initial slides, talking about an increase or growth in capacity with respect to freight rates. And the person that writes in with this question says that Amazon had a huge impact hiring local drivers. Do you feel like that's kind of playing into this increase in capacity as well?
Yeah, I think, again, going back to what we touched on just a second ago, is the technology, and Amazon certainly has. I mean, Amazon is an entirely wild. We could do a whole webinar on Amazon, and we still wouldn't be caught up to date. But Amazon providing their Amazon Flex and Amazon Prime, I can't remember the last term for it. It's dudes delivering to your door.
Right.
That's added a lot of capacity. That is, and that's the thing is, some of that we can't even account for because Amazon is very guarded to their data, and because they're a relatively new entrant in the market, it's very hard to get a handle on how much Amazon is actually impacting the broader market.
Yeah, I mean, I would agree with that. I think the real trick with Amazon is measuring the impact, not necessarily whether or not it's there. It's just getting a handle on exactly how big of an impact it is, and part of it is just because it's hard to get just Amazon specific data.
Yeah. Great. And next question, when freight rates eventually slow down, do you see driver pay also receding, or do you think that the recent pay increases might help the driver shortage in the next few years?
I mean, no. Yeah. I'll say this, and I'll let you finish. So driving jobs are the first. So when the economy is really strong, people don't want to drive trucks. That's just a fact. When the economy goes to hell, people will drive trucks because it's a job that's that everyone can do. And so that's why you have such but as long as the economy and the employment market stays strong, then you're going to have a problem. We looked at a chart showing warehouse employment, not today, but yesterday I was looking at a chart, warehouse employment growth versus trucking employment growth. And warehouse employment growth since the Great Recession is up like 170%. Or 70%, and trucking employment is only up like 18%. So we're seeing that the warehouse impact, the Amazon impact, and Prologis impact is having a much bigger impact on the market in terms of employment than otherwise.
Yeah, I mean, I would just add that generally speaking, it's hard to take wages down. That even when the economy goes south, you find things go away, you'll see layoffs, but it's hard to just reduce wages.
Yeah, and they're not going to cut the driver wage because you also have this. The drivers are getting older, and we don't have a productive immigration policy. There is no. I mean, millennials don't want to drive trucks, and I don't mean that is suggestive, but it's a tough job, and so the over-the-road market's going to be tougher. And you have to think about this: is the technology, the digitization that has made it so easy to be an operator. Your successful enterprise truck drivers that work for fleets, if they get the idea that they can be profitable being an independent driver, in many ways they'll go do that, which is a structural issue. So some of the higher quality long-term drivers have left some of the fleets to go out on their own because market conditions would merit it.
Yeah. And I guess we have time for maybe one more. Does your driver capacity projection take into account the inefficiencies of new drivers? And they say it takes about 3 years for a new driver to become as productive as those who are retiring.
Well, so let's be very clear here. So there's a couple of ways to get to that. One is the employment number, which we did look at about 2% growth. The other is we look at ELD data and look at the amount of hours that a driver is dedicated to driving. And there has been about a 22-minute a day increase, not decrease, but an increase in the time that a driver is dedicated to driving when you look at the ELD data before the mandate to after it. So we're seeing greater efficiencies in how drivers manage it. And I'll say this, it is a fact that drivers who have more seniority will be better operators. I don't think anyone will dispute that. But the ELDs, what they have been able to do is, in many ways, they're providing prescriptive and a direction on what the driver should do in terms of managing their hours better than has been in the past, but certainly better than paper. And that in many ways makes it easier for drivers to understand how to manage those hours than they did before because they're not using logbooks.
Awesome. Well, that puts us right about time. So thank you to everyone for listening in. Thank you to Craig and Ibrahim for being here today. And thank you again to our partners at Convoy for partnering with us to present this content. We have one more slide about transparency, and I know Craig is bursting at the seams to talk about this.
I'm so excited about this lineup. It is awesome. It is kick-ass badass. We have an amazing lineup, and there are a lot of speakers. We have over 60 live demos, and we've got an amazing lineup of speakers. Gary V is going to have some words that I'm not allowed to say on this call. He will tell you what he thinks. We have the author of the Everything Store, Brad Stone. We have David Rowan, Andrew Clark, Shelley Simpson, and Brad Jacobs, the visionary that really put behind XPO, is going to be there as well. So really appreciate it, and look forward to seeing you guys soon.
Yeah, we're really excited. And just a quick reminder that ticket prices actually increase tomorrow. So if you would like to lock in your $11.95 rate, go to transparency19.com. Thanks everyone again for joining us today. We'll hope you will join us again next month.